The era of easy money in American real estate is officially over. For nearly a decade, property owners operated under a set of assumptions that felt like laws of physics. Interest rates would stay near zero, inventory would remain perpetually tight, and equity would only move in one direction: up. It was a market defined by bidding wars, waived inspections, and an almost reckless optimism. But as we look at the data emerging in the current cycle, those assumptions haven't just been challenged, they have been shattered. What we are witnessing now is not a standard market correction. It is the beginning of a magnificent unraveling in specific, highly leveraged markets. The inventory that was non-existent 12 months ago is now flooding the MLS, sitting stagnant, and forcing sellers into uncomfortable conversations about price cuts. The leverage has violently shifted. The panicked buyers of the previous cycle have been replaced by patient, cash-heavy investors who smell blood in the water. And for the first time in years, the fear of missing out has been replaced by the very real fear of catching a falling knife. This shift isn't hitting the entire country evenly, though. It is acting like a precision strike, targeting 10 specific cities where speculation ran wild and where the fundamentals of local income and employment have completely detached from asset prices. If you own property in one of these 10 markets, or if you are considering allocating capital there, you need to pay close attention. The data is flashing red, and the wealth that millions thought was locked away in their portfolios is evaporating in real time. But here is the critical insight most analysts miss. The crash isn't just about high interest rates or inflation. It is about a hidden liquidity trap, forming in these specific cities that could leave even savvy investors unable to exit their positions. We will break down exactly how this trap works in market number 3, but first, we need to look at the city where the remote work premium has completely collapsed. Number 10. Boise, Idaho. We begin in the Mountain West, with a city that became the poster child for the Zoom Town phenomenon. During the peak of the pandemic migration, Boise was sold as the ultimate arbitrage opportunity. Sell a cramped condo in a coastal city, buy a sprawling estate in Idaho, and pocket the difference. Consequently, home prices here didn't just rise. They nearly doubled in a span of 30 months. Investors flocked in, buying up starter homes to turn them into rentals, banking on an endless stream of remote workers. But today, that stream has dried up. As major corporations enforce return-to-office mandates and the novelty of remote living fades, the demand for secondary hubs like Boise has cratered. The result is a massive inventory glut. We are seeing a spike in active listings that is outpacing buyer demand by a frightening margin. Sellers here are slashing prices by significant percentages just to generate showing activity. The local wages in Boise simply cannot support the asset prices that out-of-state capital created. Now that the external capital flow has stopped, the market is in freefall, searching for a fundamental floor that it hasn't found yet. This is a classic case of mean reversion. When an asset's price decouples from its utility value, in this case, the local income required to service the debt, a correction is mathematically inevitable. Boise is currently experiencing the painful side of that math. However, if you think the collapse of the Zoom Town model is isolated to the mountains, you are missing a much larger, more dangerous trend developing on the East Coast. While Boise freezes, the next city on our list is drowning in a different kind of excess that threatens to wipe out short-term rental investors entirely. Number 9. Myrtle Beach, South Carolina. Myrtle Beach represents the bursting of the short-term rental bubble. For years, this was the playground for the amateur investor. Individuals took out leverage to buy condos and beach houses, convinced that high daily rates would cover the mortgage and generate easy yield. It worked when capital was cheap and domestic travel was booming. It does not work in the current economic environment. Right now, Myrtle Beach is facing a condo crisis. Insurance premiums along the coast have skyrocketed, in some cases tripling, which has destroyed the net operating income for thousands of investors. Simultaneously, the market is flooded with sellers trying to offload these liabilities. We are seeing inventory levels for condos sitting at multi-year highs. Bookings are softening, average daily rates are dropping, and the holding costs are exploding. It is a perfect storm of oversupply and diminishing returns. Investors who bought at the peak are realizing they are trapped in negative cash flow assets. They cannot rent the units for a profit, and they cannot sell them without taking a loss on their equity. The passive income dream has turned into a monthly liquidity drain, forcing a wave of distressed selling that is dragging property values down across the entire region. But this isn't just about vacation rentals or remote work drying up. The next city reveals an even more disturbing trend: the collapse of the tech hub premium that drove prices to astronomical heights. We are seeing a level of wealth destruction in this next market that hasn't occurred since the dot-com bust. Number 8. Provo, Utah. Located in the heart of what was dubbed the Silicon Slopes, Provo experienced one of the most aggressive housing bubbles in the nation. It wasn't just coastal money moving in, it was venture capital-backed optimism. Tech startups blossomed, and housing prices surged to levels that rivaled major metros, completely detaching from the reality of what the average family earns. Now, the tech sector contraction has hit hard. Hiring freezes and workforce reductions in the software industry have removed the high-income buyers who were propping up this market. But the developers didn't get the signal in time. Utah is currently sitting on a massive surplus of new construction inventory. You can drive through neighborhoods where rows of brand new homes are sitting finished and empty. Builders are desperate to move units. They are offering interest rate buydowns, free upgrades, and covering closing costs, essentially slashing the effective price of the home while trying to keep the list price high to protect comparable sales for previous buyers. But the absorption rate has stalled. The monthly debt service is simply too high for the local workforce to sustain without the stock options and bonuses of the previous cycle. Provo is watching its equity dissolve as the Silicon Slopes narrative meets the harsh reality of capital constraints. And if you think the tech fallout is contained to the mountain states, you need to see what is happening in the South. The next city on our list proves that even the most hyped migration destinations have a breaking point, and we have officially passed it. This next market is facing a double trigger event involving insurance and inventory that experts say is unprecedented. If Provo's tech-driven collapse was the first tremor, the next city on our list represents the full earthquake. It proves that simply being in a state with low taxes and good weather isn't enough to save a market when speculation runs wild and the underlying mathematics break down. We are shifting our focus to a region that was once considered invincible, a place where people assumed the migration pattern would last forever. But in the current cycle, the data tells a story of reversal and regret. Number 7. Cape Coral, Florida. For years, Cape Coral was the ultimate destination for retirees and remote workers fleeing the Northeast. It was affordable, sunny, and most importantly, it offered a lifestyle upgrade at a fraction of the cost. During the peak of the recent boom, it became one of the fastest-growing cities in America. Builders couldn't pour concrete fast enough. Every vacant lot was snapped up by an investor or a retiree paying cash. Prices surged by double digits year over year. But today, Cape Coral is the epicenter of a new crisis: the insurance apocalypse. Following a series of devastating hurricane seasons, insurance premiums in Southwest Florida have not just increased, they have become a second mortgage. Homeowners are seeing annual premiums jump from $2,000 to $8,000 or even $12,000 in the current renewal cycle. For retirees on fixed incomes, this is catastrophic. For investors, it destroys net operating income instantly. As a result, inventory in Cape Coral is exploding. We are seeing a flood of listings hitting the market as owners try to offload properties before another storm season or another premium hike. But buyers are terrified. They are looking at the monthly holding costs, mortgage plus insurance, and walking away. We are seeing price cuts on nearly 40% of active listings. The sunshine tax has become a literal tax that nobody can afford, and it is dragging the entire market down with it. But if you think the insurance crisis is the only thing sinking Florida markets, you haven't seen what is happening in the next city. While Cape Coral struggles with natural disasters, our next location is dealing with a man-made disaster of corporate greed that is backfiring spectacularly. This next market is drowning in inventory due to a failed Wall Street landlord experiment. Number 6. Jacksonville, Florida. Jacksonville was supposed to be the stable, affordable alternative to Miami or Tampa. It attracted massive institutional capital, hedge funds, and private equity groups, who bought up thousands of single-family starter homes to turn them into rental portfolios. They bet big on endless population growth and perpetually rising rents. That thesis has failed. In the current market, Jacksonville is drowning in rental inventory. Developers built thousands of new apartment units and build-to-rent communities at the exact moment migration started to slow. Now, landlords are forced to compete for a shrinking pool of qualified tenants. We are seeing rent concessions everywhere: 2 months free, 0 deposit, gift cards. When rents drop, property values follow. Investors who bought at the peak based on projected rental yields are now underwater. They can't cover their debt service with the lower rents, so they are forced to sell. This wave of institutional selling is hitting the market just as regular buyers are pulling back due to high interest rates. It is a double whammy of supply. Jacksonville is watching its price gains evaporate as the institutional model cracks under pressure. But the pain isn't confined to the coast. If we travel west, we find a city that proves even the most robust cultural hubs can't sustain housing prices that are completely detached from local wages. The next city is a cautionary tale of what happens when a cool city becomes too expensive for its own people, leading to a massive demographic shift. Number 5. Nashville, Tennessee. Music City was one of the hottest real estate markets in the country for a decade. It became the "it city" for corporate relocations, entertainment industry growth, and high-net-worth individuals looking for a tax haven. Prices in Nashville skyrocketed, pushing the median home price well beyond what the average musician, teacher, or service worker could afford. Now, the affordability crisis has hit a wall. The local workforce has been priced out entirely, and the influx of wealthy out-of-state buyers has slowed to a trickle. Homes that used to receive multiple offers within hours are now sitting for 60, 90, or 120 days. Sellers are chasing the market down, slashing prices by $50,000 or more to find a qualified buyer. We are also seeing a massive glut of short-term rentals in Nashville. Investors bought condos specifically for the tourism market, banking on high occupancy. But as travel budgets tighten in the current economic climate, tourism is softening. Those units are sitting empty, forcing owners to either convert them to long-term rentals or sell them at a loss. Nashville is learning the hard way that a city cannot function if the people who work there cannot afford to live there. However, if you think Nashville's affordability crisis is severe, it pales in comparison to the absolute devastation happening in the next city. Number 4. Charlotte, North Carolina. For a decade, Charlotte was the banking capital of the South. It attracted massive corporate relocations and thousands of remote workers fleeing higher-cost metros. Prices soared as demand overwhelmed supply. It became a seller's market on steroids. But in the current cycle, that dynamic has reversed violently. Charlotte is now ground zero for the iBuyer collapse. Companies used algorithms to buy thousands of homes intended to flip them for quick profits. They overpaid, drove up prices artificially, and created a frenzy. Now they are stuck holding the bag. We are seeing a flood of inventory hitting the market as these corporate flippers liquidate their portfolios at losses. They are dumping homes back onto the market, undercutting regular sellers, and driving down comparable sales across entire neighborhoods. If your neighbor is a corporate entity desperate to liquidate, your home value drops with theirs. But if you think corporate dumping is the only threat to your equity, you need to look west. Number 3. Phoenix, Arizona. Phoenix was the ultimate Zoom town boomtown. It saw some of the fastest price appreciation in history. People moved from California in droves, bringing coastal salaries and bidding up prices 40%, 50%, sometimes 60% over asking. Builders responded by constructing thousands of new homes in the desert, assuming the migration would never end. They were wrong. In the current cycle, Phoenix is facing a massive inventory glut. The California exodus has slowed significantly as companies call workers back to the office. Construction jobs are drying up as new projects get canceled. We are seeing price cuts on new construction that are staggering. Builders are desperate to offload inventory before carrying costs eat their margins. They are offering $50,000 in incentives, free upgrades, and rate buydowns. But even with these deals, homes are sitting. The resale market is frozen. Sellers who bought at the peak are now underwater. But if you think Phoenix's desert bubble is bad, wait until you see the tech hub collapse happening in the next city. Number 2. Austin, Texas. Austin was the crown jewel of the real estate frenzy. It was the destination for Elon Musk, Joe Rogan, and thousands of tech workers fleeing California. Prices didn't just double. In some neighborhoods, they tripled. Bidding wars were legendary. But in the current cycle, Austin is a ghost town of crushed expectations. The tech layoffs at Meta, Google, and even Tesla have shattered the local economy. Inventory has exploded to levels not seen since the 2008 financial crisis. We are seeing price cuts of 20%, 30%, sometimes even 40% from the peak. Sellers who bought in 2021 or 2022 are trapped. They owe more on their mortgages than their homes are worth. Builders flooded the market with thousands of new units. Now, they are slashing prices aggressively, undercutting existing homeowners. However, if you think Austin's collapse is the worst of it, you haven't seen the devastation happening in the next city. Number 1. San Francisco, California. San Francisco was once the most expensive, exclusive real estate market on earth. It was unstoppable. But today, it is broken. The combination of permanent remote work, a massive homelessness crisis, and an exodus of major retailers has decimated the city's appeal. Downtown office towers are sitting 30% vacant. But the housing market is where the real pain is. We are seeing luxury condos selling for less than they did in 2015. Sellers are taking losses of $200,000, $500,000, sometimes even $1 million just to get out. The tech exodus is real. Even single-family homes in desirable neighborhoods are sitting for months. San Francisco proves that no market is invincible. But this isn't just about 10 cities. This is a signal for the entire country. Next section will break down the contagion effect, how the crash in these markets will bleed into the broader economy. The collapse of these 10 specific housing markets is not an isolated event. It is a contagion. When billions of dollars in equity evaporate in these cities, consumer spending contracts nationwide. At the same time, the banks that hold the mortgages begin to tighten their lending standards everywhere. This is the credit crunch phase of the cycle. For the average homeowner, this affects you. It means your home's appreciation will likely stall. It means refinancing will become harder. And it means the job market will likely soften. But here is the silver lining. While the tourist investors are panicking, the resident investors are preparing. The strategy is called cash flow arbitrage. In a crashing market, the price of the asset falls, but often the rent does not fall as fast. This creates a window where the price-to-rent ratio becomes favorable again. Investors with cash are hunting for distressed sellers. This is how generational wealth is built. Conclusion: the Great Reset. So, what does this mean for you? If you are a homeowner, be realistic. Price ahead of the market. If you are a buyer, patience is your weapon. If you are an investor, look for yield, not hype. Storms eventually clear, and the landscape left behind will offer incredible opportunities for those who are prepared. Stay safe, watch your equity, and I'll see you in the next video.